Understanding estimated tax payments. Estimated tax payments seem to be a very confusing area for most taxpayers, and generally we have questions about this each tax season, especially if it's the very first time this has occurred for some of our clients. What estimated tax payments are is an amount that the government says they want upfront or a little bit ahead of time in relation to the amount of money that you're earning. What the government does is they want their money pretty much as you do earn it. And so it's a little bit like a loan in the fact that they want their taxes as you earn those funds. So they want you to pay that in essence quarterly. It's not quite right on the quarter. The estimated payments the government wants are April, June, September, and either December or January. We always talk about them in a quarterly basis. It's just easier to mention, but that's generally what it is. When you end up having to pay estimated tax payments, it's because you owe during the tax season typically. And generally the government looks at it and says, if you haven't paid in at least 90% of the current year's taxes at tax time, or 100% of last year's taxes when you go to file the tax return, they could subject you to underpayment penalties and interest. The other caveat to this is if they are a high income earner, according to the government, that's over $150,000 of adjusted gross income, then they want to make sure that you have it paid in at least 110% of what you owed last year. There's a few special rules too for farmers and fishermen. They don't have to make estimated payments, but that's another time and another story for those. Also, if you don't owe more than $1,000 in taxes, you may not have to pay estimated payments either. Again, it's really dependent on your own specific situation, but in general, those rules will apply. Income, if it's received unevenly throughout the year, you may have a little bit different option as well. You can make estimated payments based off of when you earn your income. The little bit of the rub with that is when you go to file your tax return, then you have to do another reporting form, which helps you to show when you actually earn that income and then when you actually made those payments. By doing that, then you can alleviate some of those underpayment penalties and potentially interest. Some of our clients do get caught off guard with those underpayment penalties and interest because they haven't made estimated payments. And that's because they haven't followed the rules according to the government of having at least that 90% paid in from the current year or 100% from the prior year. When you're doing your taxes, just make sure that you're monitoring that situation and hopefully you can avoid some of those issues. One other area where the government get a little bit of loophole anyway with the government is with W-2s and your IRA RMDs. The government looks at withholdings from those two items as if it was given to them evenly throughout the year, even if you do the entire amount of withholding on that very last payment or that last pay stub that you have. That's just one little facet that could help you. If you are caught off guard a little bit for estimates and you're underpaid, you could have additional withholdings on an RMD, maybe that you're taking towards the end of the year or that last paycheck or the last few paychecks in order to try to catch yourself up. I'm happy to answer any questions that you may have regarding estimated payments. Give us a shout and we'll do our best.